Welcome to stockexposure.com. My name is Abhijit Mukherjee. I am Chief Strategist and founder of the website. I'll be talking about our 2024 portfolio today, and we'll discuss about how we have timed exits in stocks across the portfolio for the year. We've managed to double our capital. In fact, a bit more than that. We generated a sum total of 140 R. So this presentation aims at actually highlighting when's the right time to exit names that have given several fold returns. The standard disclaimer applies. Investments in the stock market are subject to market risks, and we aren't SEBI registered since the business that we solicit is purely for educative purposes. The fundamental foundation of our entire approach is that it never really matters what names you bought as much as it mattered how much of it. It's important to understand this, that you could have a portfolio of say 50 stocks or 60 stocks, and some of them will be multi-baggers. But then the number of duds will be so many that the portfolio returns will not be very impressive and you'd barely beat the index. In order to truly outperform and to generate wealth, you have to have concentrated bets. And for concentrating these bets, you need to know how much of your portfolio you must allocate in every single trade. Coming to our strategy, of course. Our strategy is pretty simple. We buy base breakouts or jump onto any momentum name. Why do we do this? Because we don't believe in buying value. We believe in chasing price as soon as it's making its move up. On our website, we've mentioned something called the stage analysis. You'll find it at the strategy section. In stage analysis, we do a very basic understanding of what a base looks like and at what time does it ripen up where it produces a trend. Most bases will begin with something like this: tightening concentrated range, and at the time of it really getting narrow, you usually see a burst. This burst is a breakout, after which you will find a trend develop. As a trend develops, you can make money. So you enter right here, and you try and ride this wave and exit somewhere around here when it matures. The three names that we are going to discuss in today's presentation are TRENT, ZOMATO, and RAYMOND. All three of them bought on 19th of April. This was one day that Nifty made an outsized move, and we thought it was opportune to jump into names that looked really good on the charts. Our trading plan constitutes the SNAP framework, a good market context, and we determine what's a good stop loss, which helps us figure out what our initial risk would be. Why this is important is because we need to size position well. We've mentioned about this. So when we find any sector which is hot, we look for certain names on that. And the ones which have got good news in the form of, say, either earnings or something related to the industry, we realize that we will focus on such particular instances. Then, of course, we need to find evidences of accumulation. Accumulation basically means big hands have started buying the stocks at any value price. If you would have read about Warren Buffett's work or someone who works at a large hedge fund, what they'd probably try and do is they try and buy stocks when they have corrected like this, and they'll come down a bit and they'll probably just wiggle around here. This, after an uptrend, this is what accumulation looks like. People buying, big hands buying at lower levels. A lot of novice traders would bought, say, somewhere here, would start exiting here. But this is when the big hands come in. So this looks like a base, which is called accumulation. And then, of course, we focus on a pattern. I've mentioned about different types of patterns that you can use to enter in. There's something called the J hook that we use. And then, of course, there's something called the bull bar. What we sometimes do is when we get a decent enough swing level, we just buy above the swing high. So whenever the stock price goes up, we just buy the swing high and keep a stop loss just at a reasonable level below. And then, of course, the market context has to be good. The moving averages must align, and there has to be a discernible price void. This little example that I just drew here on the sketch figure shows that there's an entire price void here. Nothing to the left of the chart. And the appropriate patterns for any reasonable trade will develop at a time when the 20 MA, the 50 MA, and the 200 period moving average, all of these will align in perfect sync, and it won't be messed up. So looking at all these factors, we have a pretty pretty complete trading plan. The last point that I mentioned, the reason to exit, is the reason that we are discussing in this presentation, and I'll show you illustrative examples right now how to determine that. Let's look at TRENT, for example. TRENT in early February was a darling because it had been moving up. It had formed a very good base. It had broken out, and this had happened several times over. It's been a multi-bagger for the last few years, so it rolled up. It sort of corrected into the 50 period moving average. What usually happens is when you have these three moving averages lined up, the 8, the 20, and the 50 period moving average, usually what will happen is that the value level, like say the 50 period moving average, on any opportune day, like an earnings day, you're going to get an entire bull move up, single bar move. This is little difficult to buy because you don't know whether this is an ignition bar or an exhaustion bar, given that you've already made the move from here. What instead we tried doing was we tried buying the first pullback into the moving averages as we started seeing some form of evidence of price contraction. So in early March, we took our first entry and we promptly got stopped out 2 days later. A TRENT is another example of a re-entry trade, wherein after getting initially stopped out, because our stop was pretty tight on this, what we did was we re-entered in the middle of April. That was specifically on 19th, when we found another pretty decent pattern setting up. And in fact, this pattern looked better than the first one. The first one was a pretty premature trade because it seemed like a high tide flag. But by the middle-ish end of April, we had an entire mature base form on this. So this looked like a much better trade. And our initial stop was pretty much the same, just about a couple of bars below. And we entered at the close of day. Thereafter, of course, the intention was if the breakout does work, we start trailing. And that's what we found. As we moved ahead, we realized that we're getting this big move up. So all we needed to do was wait for these swing highs to keep breaking. This was the first swing high which broke, so we adjusted our stop here. The second swing high formed here, so we adjusted our stop here. The moment it got taken out. Then again, this swing high got taken out, therefore we adjusted our stop here. In fact, when we saw such a large bar, we kept our stop at the bottom of this level, and we then did again another 8 MA run. As this run got more and more mature, we realized that we're probably going to be finding a market top pretty soon. So here, then here, and finally here is where our trailing stop went up. We had one final hurrah in early October, but the bar went up, cleared it out, and we decided to take profits at this level. If you study this chart very carefully, we've had several big bars form as part of one single uptrend, each one of them looking more exhaustive than the other. But by now we realized that the trend had matured, and what we eventually realized is that our trailing stop got hit and we booked pretty handsome gains. Now moving on to Zomato. Zomato was a stock that everybody wanted a piece of, and I was extremely skeptical of it. If you look at its chart through 2023 and then running into 2024, it formed what I would call a lazy trend. This is creeping around. You see the 8 MA and the 20 MA are constantly just meandering along. As this happens, one really can't figure that if this sort of a move can sustain much. When you're looking for momentum, you're looking for clean breakouts or a clean base. This upward channel sort of move, it's very difficult to trade unless you have an entry. I experienced this firsthand because in April when I did buy it, I bought a double bottom thinking this is going to form some form of a high tide flag. This is a very poor entry, which I must say, and it's a bit embarrassing disclosing this. Anyhow, after this, what I did was I waited, and the wait seemed a little fruitful because in July, or shall I say at the end of June, post the general election results, what we found is that a curved bottom got formed, and then we had a little bit of a handle. So this is usually called the cup and handle. This bar on the great entry pattern, it's a bit of a J hook, not the most perfect example. This was our entry, or shall I say a re-entry on this particular trade. Again, after our first entry failed, we entered with the same price level and the same stop level. Then we wrote this particular name all the way up. Our stop kept getting adjusted. We had a dip down. Again, when we found this sort of a bar form here, this is a perfect J hook. We adjusted our stop here. And then, of course, our stop got taken out at the end of September at this particular swing level. When the market went up, it came and it took out a trailing stop. And we returned pretty handsome gains for this thing as well. And then similarly, Raymond, we found a pretty textbook pattern here. Now, if you see from April 2013, we had one initial move up. This was a spike. We would have had a great entry here. This could have been the perfect high tide flag either here, or you could enter here. But this is not what we were looking for because this was sparse data. Raymond went up and it got exhausted. So Raymond, after having a two-legged up move, which could broadly be witnessed as one move up, started correcting. It fell to the 200 DMA, corrected, formed a sort of double bottom if you see, and then had two tops as well. So when you have this sort of a rectangular price formation, this is a box really, so it's a sort of tightening zone. We had one breakout bar, which was a bull bar. This particular bull bar on 19th April looked like the perfect buy from a rounding base. We had an up move and then we had a rounding base, all got constituted in about 12 months. I was expecting a move which would actually last at least the length that we got from April to September 2023 in terms of magnitude. And oh boy, was I proved right. So this was our entry day. This pattern is simply a bull bar. You get a nice full voluminous bar. And we entered at the close of this particular day. After, of course, 4 June, the election results day, we didn't really have our stop taken out. And in any case, the market did correct back. So at the close of this day, we actually adjusted our stop to the bottom of this bar. We saw one leg up. This leg up really gave us profits because once we had another J hook form here, trailing stop got adjusted, and towards the top, we exited when we had bar by bar getting taken out. When you have vertical moves like this, start trailing your stop at the low of every bar. So when you have a bit of a correction, you exit right here. If I had to talk about how this affected our entire portfolio, you will observe that the risk multiples that we achieved pretty impressive. While the stock might have moved about 93.5%, or say close to 50 odd percent, because we were risking no more than say 5% as a risk level, we got a multiple of close to 20 or 10 or 12. And for an entire return for of say 140R that we generated, a good 40R came from these uh, these three names. The three names can give you 30% of your overall, roundabout, yes, of course, 30% of your overall gains for the year. It just goes to show that the power of buying and holding and trailing. And if you see our entries marked out on our track record sheet, which is again available on our website, mention when we exactly exited these. So if you're interested in knowing more about our work, or if you've been following us yet, I'd urge you strongly to subscribe to any of our plans. Um, Either plans come with pretty decent free trials, and the pro plan, which I'd actually choose, is the one where we'd now start updating a lot of rich content. When I say rich content, regular videos, videos such as these, where I'm explaining exactly how we've done stuff in the past. And we'll be mentioning about all stocks on our watch list. So if you really are interested in seriously replicating such success, uh, the Pro plan is your go-to. It comes at a pretty affordable 5,000 rupees every month. If you were to contextualize it for 60,000 rupees annually, you might have a pretty decent. And if you've got perhaps a portfolio, say in excess of say 10 lakhs or 20 lakhs or so, it's less than a percentage of your returns that you could possibly earn. So if you're looking to earn say about 20 to 30% for the entire year, I think fee probably will come to just about a percent or so. If you're still a newbie in the space, you could also settle for the gold plan. A lot of the educative content is updated here. The fundamental difference, again, like I'm saying, new trade ideas and weekly trade review videos will come with the pro plan, but this should also hold you in good stead. You do a little bit of heavy lifting through this, but if you want to make life a little easier and want to reduce your learning curve, this is what I'd suggest. Thank you for joining us, and stay tuned. I'll be uploading more videos detailing more of our trades, and good luck with your investing journey.